Firstly, let me tell you some of the contextual matters as well as some misconceptions before I get on to that part of my presentation. Now, as we have already said, the EPF is by far the largest investment fund in Sri Lanka. It will have a disproportionate clout in the capital markets if it is allowed to operate without a carefully crafted investment framework, and not only distort the capital markets, but even possibly the monetary policy transmission. So the first point I want to make is that the central bank is actually caught in between a rock and a hard place when it comes to managing the funds of the EPF, which it undertakes as one of its several agency functions. According to the literature that I have seen, this function was resisted by the central bank at the time the EPF came into being in 1958, I think, because I think it was realized that having EPF under its wing meant that the monetary board and the officers of the central bank had responsibility for three conflicting things. The primary statute which governs the central bank's responsibility is the Monetary Law Act, and one of the primary responsibilities is responsibility for price stability, which requires it to control inflation using monetary policy, where a main policy tool is the increase or decrease of policy or market interest rates. So that is the first main objective of the central bank. Then, as an agency function, the central bank is responsible for raising and managing the government's public debt denominated in both local and foreign currency, and making the required funds available to the treasury. Now, in this job, the central bank has to act in the best interests of the treasury when carrying out this activity as an agent of the government, which translates to mean that it should raise funds at the least possible cost to the government at an acceptable level of risk. The latter being done by making sure that there are various tenors to prevent bunching of repayments. So that is the second thing that the central bank gets involved in. Then the central bank is responsible also for the management of the investments of the EPF. Not the general administration of the EPF, but especially in relation to the investment side. This is also undertaken as an agency function, but the wording in the law implies even a higher level of responsibility, which is more aligned with trusteeship, in that the EPF Act refers to the monetary board being the custodian of the funds of the EPF. And it has been given the authority to make investments as it deems fit. Now, this phrase, taken in the context of the whole law, cannot be interpreted literally, and does not mean that the monetary board has the freedom to do anything it likes with the money, since the principles of trusteeship and public law doctrine imposes on the board a very onerous responsibility to act in the best collective interest of its members at all times. Although at the time these conflicting arrangements were legalized, balancing these different objectives may have been not overly complex, given the macroeconomic fundamentals prevailing at the time. With the decades that passed, with progressive increase in fiscal dominance and ever-increasing budget deficits, the situation changed. Functioning in an environment of raising money for a borrower with an almost insatiable appetite, and which had to be raised by way of debt on the one side, and managing the investments of the largest repository of savings that is compelled to invest in risk-free or low-risk assets to discharge its mandate on the other side, and then to sit in the middle to ensure price stability by increasing or decreasing interest rates, was actually quite a challenging job. I must add that these conflicts that I mentioned primarily related to the investments and the debt raised through in securities, in fixed income securities such as treasury bonds, and it required a carefully drafted and diligently implemented set of controls, checks and balances to avoid problems. Now, what the forensic reports, audit reports, as well as other investigations show is that there were insufficient controls, and even what was there was not properly implemented. There are conflicts that arise from equity investments as well, which I will refer to a bit later on. Then there are some misconceptions that also need mentioning. The first is that there is a belief, even at the highest levels of the public and political administration in Sri Lanka, that the EPF is a state entity and a state fund. I think it was alluded to in the earlier presentation that it is in fact not so. It is under an act of parliament, and the state takes responsibility for certain administrative arrangements relating to the fund. But however, the fund itself, by which I mean the members' money, are not state funds. They are monies held in trust for members by the monetary board. Thus, there is a distinct difference between the EPF funds and, say, a state-owned enterprise such as a state-owned bank, where those respective laws of those entities provide for the ministry to issue certain instructions relating to their activities. So the EPF is clearly a different animal. The second misconception is that every loss is a fraud or a scam, which is not the case. In any investment activity, there is some degree of risk that could be specific to the financial performance of the investee or arising from other circumstances. The market cannot exist unless investors accept this. Now, with regard to investments in government rupee bonds to be held to maturity, the reasonable assumption is that the government won't default on those, and therefore you will realize the face value of the instrument at maturity. However, the price that different people pay to buy it, because sometimes some might pay a higher price to buy a bond even in the primary auction, which gives rise to what is referred to as the winner's curse, or in the secondary market, but by itself is not necessarily a fraud. It will be a fraud if that higher price was paid due to intervention by someone to actively, or for that matter passively, direct the buyer to pay that higher price to permit someone else to gain from that action. I think that was also referred to, I think, in the earlier presentation. The third misconception is that there were checks and there were no checks and balances relating to the investment activities of the EPF, which is also actually not correct. There always were, but unfortunately, the level of fund management skills and expertise was not sufficiently deep and not that well understood by some of the senior officers who were placed there through the rotation policies of the central bank's staff rotation policies. In fairness, the EPF have attempted to build up those skills in the 1990s by recruiting a group of CFA qualified persons, but the initiative had been dissolved due to resistance from some unions and other internal factors. So while there were shortcomings in these, the bigger issue that came to light has been that the processes which were even there had not been followed by those charged to do so, in part due to lack of knowledge and capacity, and in part, I would say, due to negligence. This has all been documented in the Presidential Commission reports as well as in the forensic audit reports. So now in that background, let me now refer to some of the main procedural and process shortcomings that were identified and the actions that were taken with the intention of correcting them. Now, these all happened, as I said, in 1919 and 1920, even before the reports came out of, I would say, from about 2018, not even before forensic audit started. And and we have communicated these to the relevant authorities like COPE. So this is nothing secretive about it, but I will distill them all here. Now, the policy conflicts that I referred to was to some extent managed by keeping EPF out of investing in short-term treasury bills, since the short-term interest rates are more relevant for monetary policy management and transmission. So EPF, generally speaking, except may have been under some very exceptional situations, invested in treasury bonds which were of a relatively long durations in the primary market. The central bank has also further tried to avoid the conflicts that I referred to by having separate departments to handle the EPF and public debt, headed by two superintendents who reported via different hierarchies to different assistant and deputy governors. While this is in theory, maybe sounds all right, in practice, this alone might not have always resulted in watertight compartments when dealing with the conflicts institutional conflicts that I spoke to you about, because those people higher up had multiple other responsibilities as well. Now to deal with this situation, the EPF had developed investment policies, had put in place the investment committee. There were decision-making limits with a hierarchy and a separation of front and back office. But unfortunately, what the audits and investigations showed was that the processes that had to be followed were not followed. And too much power was vested on relatively low-level officers without sufficient oversight. So what the central bank did when that came to light, long before these audit reports came out, was to take immediate steps to change the officers who appeared to have derelicted their duties. Most of the staff were changed, and also commenced disciplinary proceedings against some of the officers against whom there were credible evidence of exceeding their authority and causing losses through irregular trading and investment activities. Now, there were also several shortcomings on the physical side. I mean, any of us who have been into a dealing room knows that a dealing room is a restricted area with access controlled and would normally have sophisticated voice and recordings and CCTV recordings. Now, the EPF at that time had none of that, which made surveillance and post-audit activity almost impossible. So steps were put in place to remedy this. Of course, the procurement procedures of the central bank, being a government institution, does not allow it to move as fast as one would like. But anyway, some interim steps were taken, and the more substantive steps were being undertaken at the time that I left. Then going further, one of the issues that perhaps led to this situation was the insufficient price discovery mechanism for treasury bonds, which was in the market. This was actually not the fault of the EPF, but arose because the GSEC government securities secondary market transactions were over the counter and not on any kind of a exchange or a public platform. The public debt department did have a method of disclosing guidance prices each day, but these prices were not based on actual traded prices. A process was introduced whereby primary dealers, therefore a process was introduced whereby primary dealers had to publish actual transacted prices without identifying the parties for government bonds on the Bloomberg platform, which was used by primary dealers. Initially, the price disclosure was for transactions of 50 million rupees and over, but it was later, I think, brought down to 5 million rupees over time. Now, this was a move in the right direction, but of course is not perfect, since there can be time lags and human errors, omission or commission, that could cause misinformation to be disseminated. So ideally, you would like a more platform where this information gets disseminated I mean, instantly and actively. One other factor I think you alluded to about the secondary market transactions of the EPF. Now, what was found was that the EPF success rate at primary auction bids was very low in many of the years. I think Anushan gave some of the numbers, thereby leaving them with no choice but to acquire securities from the secondary market, because the EPF had by law and by requirement had to have a fairly high percentage of over 90% in government securities for safety reasons. The investment policy and operating guidelines that were revamped mandated the investment committee to function proactively through daily meetings and give guidance for placing auction bids in a manner to achieve a high level of success and to reduce dependency on the secondary market, especially for the held to maturity portfolio. Earlier, there was EPF used to place bids in the auctions, but most of them were not successful because they were placed at without, in my view, without due regard to actual market conditions. But given that they had investment analysts and a whole team of people who were charged with investments, we felt that they should be more responsible in placing bids in the primary market in a manner that they will succeed, given that they had no choice but to acquire these securities for their portfolio. So by doing that, we shifted the emphasis from trading to investment. Although a trading portfolio was permitted, since the Monetary Board felt that an active market in government securities and treasury bonds was actually in the interest of the EPF, apart from being in the interest of the market as a whole. It was also felt that it was also served the interests of EPF to do so. Then transaction limits and other risk limits were set through the operating instructions with a strict requirement to follow them on a proactive basis, which had not been the case in the time gone by, rather than ratification mode, which had been the previous prevalent practice. Everything was ratified. There was nothing really done on a proactive basis, which essentially meant that the decisions were actually done at a much lower level, and there was really nothing one could do when even if those decisions were not found to be correct. The middle office was strengthened to check compliance and also check off-market transactions using various reports that were available or newly designed for this purpose. There was a lot of information that could be gathered through various systems, and we put in place a mechanism. I don't think everything was completed by the time I left, to actually improve the amount of management and analytical information that is available to the EPF. The one other important thing was that the fund management activities of the EPF were brought within the internal audit universe of the central bank. Previously, there had been a misconception that the EPF had its own outsourced internal audit function, which was true, but without realizing that its scope was limited to verification of member payments. And actually, they had no involvement over fund management activities. So, like every other department of the central bank, the EPF was also brought into the audit universe of the central bank, and certain audits were commenced during 2019. Then the document retention, especially computer records, were strengthened throughout the central bank and also in the EPF. Now, there was no proper policy at the time for the retention of computer records or emails, and this came to light even has been pointed out in the audit reports as a limitation, and greater control over the retention of emails, including placing of litigation holds, where appropriate, were introduced. Then this again is not a measure taken by the EPF, but the primary issue of bonds was reverted from the pure auction method adopted after 2015 to a hybrid auction and placement mechanism. However, unlike in the pre-2015 period, the direct placement of the government securities through bilateral transactions was done away with. And when an auction was not fully subscribed, primary dealers and EPF were required to participate in fixed price volume auction with a first refusal allocation linked to auction success. This eliminated the issue of securities by public debt department with differential pricing to market participants. So there was much more transparent way of allocation as well as pricing. Then central bank established a new risk management department, which provided independent input to the revised and revamped investment policies and guidelines of the EPF before these were approved by the Monetary Board. I recall a lot of interactions that happened between the two departments, healthy discussions and arguments, but finally there was a consensus reached and they were approved by the Monetary Board. And there was a mandatory annual review of all operational manuals and policies and a sign-off by the deputy governor in charge for any changes incorporated, or he had to sign off on to the effect that the review has taken place and there were no changes unnecessary. Because we found that some of these procedures and manuals are very outdated, as the dates are given in the forensic audits, as you can see. Some had been quite outdated. Then in relation to the issue of on the bond issues as well, where an advance notice calendar and rationalization of the ISNs to be issued was introduced, and ad hoc auctions were done away with, which also assisted the EPF to organize its activities. Then code of conduct for staff involved in investment management activities was introduced, which was separate from the general code of conduct for central bank employees, which imposed certain restrictions and disclosure requirements on activities on investment activities. So these are not all, but these are some of the main steps that that have been embarked on, and some of these were actually work in progress, and I presume continued even after I left. But I cannot vouch for that. But so there's quite a lot that happened. Now let me just go to the investment in the equity investment side. Now with regard to equity transactions too, there were several adverse findings as already presented. And as was said, the EPF withdrew from the equity markets. And although there was an understandable reluctance on the part of the EPF staff to engage in equity investments because of everything that had happened and all the criticisms leveled at those investments, and asset allocation to equity was considered desirable by the Monetary Board, considering the long-term nature of the EPF, but with the realization that it had to be done in a manner that addressed the previous shortcomings. Now, to this end, the EPF and the central bank took note of where things went wrong and took certain strengths to strengthen the processes and controls and the governance before we re-embarked on equity investments in a limited way. And I think that process has now got some maturity and has got expanded from what I see from what has been disclosed by the EPF. Firstly, all the infrastructure enhancements necessary for control and oversight of fixed income securities were also introduced for the equity side. This includes the designing of new investment guidelines, operating procedures, risk management, and strengthened middle office functions, as well as physical infrastructure facilities which facilitated oversight. The investment committee role was strengthened. IC was required to select the eligible equities through a formal process of assessment and obtain prior clearance of the Monetary Board, but actual trading decisions thereafter to be taken by the investment committee and executed by traders. Then there is a monthly progress report to the Monetary Board. But now this is not necessarily new, because these things were there earlier, but unfortunately not necessarily followed, and various people at various levels had sort of taken liberties with it, and perhaps and some occasion put it up for ratification, and some other occasions had not even bothered to do that. So, but basically this was basically strictly enforced. Then periodic evaluation of the brokers used and attempting and there were attempts sort of there were practices put in place to reduce broker concentration and to share the business in a more equitable way. Of course, bearing in mind not all brokers were equally competent or had the equal capacity. So basically one has to bear in mind the ability of brokers as well. But this was also formalized in a formal way. The one other important thing that we done was we made EPF a passive investor and not an activist investor. This was on the basis that as a conservative investment fund with widely dispersed beneficial owners, a prerequisite for investment was confidence in the management. And because if the fund did not have confidence in the management, they had no business in investing in that entity in the first place. And it was undesirable for the EPF to permit its shares to be used to influence changes to boards of directors of companies, or at the behest of government, or at the behest of any other party. The EPF was required to obtain prior monetary board approval for voting against resolutions which were recommended by directors, and they had to justify as to why they would do so. On a couple of occasions, the EPF department did so, and the monetary board did decide, I think, to vote against certain resolutions. But there was a process brought around it, because whereas earlier there were these decisions were taken at a much lower level and influenced by various people, both inside and outside the central bank. While there is, and there was this argument which was sort of going on that EPF should not invest in shares of regulated financial institutions, because that in itself created a conflict, because the central bank was the regulator of financial institutions as well, and was also responsible under the law for financial system stability. This is actually the fourth conflict, which is specific to this issue, which on top of the three other conflicts that I mentioned. However, one cannot completely disregard that financial institutions are a significant component of the listed equity market that have time-tested track records, despite various ups and downs on a temporary basis. At least many of them have had time-tested track records. And by completely ignoring this system, the EPF could and possibly will fall short of serving the best interests of its members. Now, this reinforced the requirement to be passive investors in financial institutions, undertaken on a proper analytical basis rather than with the intention of controlling them. So basically, the passive investor thing was reinforced through this requirement of investing in financial institutions. Then one of the other things, I mean, the reference was made to the delay in submission of information for the public domain. I won't comment on the RTI matter, but actually the law requires the central bank to provide the financial statements audited to the minister, who in this case is the Minister of Labour. And I can assure you that all that was done in a timely manner. The publication of the annual report is actually a matter undertaken by the Minister of Labour, who then submits it to Parliament. Now that process, I agree, has taken a long period of time. So there was this debate going on, which was not resolved at the time I left, whether the full set of financial information could be published at the time when the information was submitted to the minister. But there was no resolution, and as far as I know, there was some legal opinion pending on that. As to what transpired after that, I do not know. So if that information has not been made available, I can only presume that it was because that it was said that there was insufficient authority for the central bank to do so. But but I would say personally, from a point of view of good governance, the sooner that information is made available, the better. But then there are some things where the legal provisions take precedence over what might be good practice. Okay, now what I have said is not an exhaustive list of things that have been done or being done on the basis of the fund which is continued to be managed entirely within the central bank. Now, one should also bear in mind that while processes can be defined and IT-based system controls also can be introduced, there is still a high dependency on humans for the adherence to and governance relating to those processes. And on this journey, there is much more work that needs to be done. And the human beings there will need to really pull up their socks and do what they have to do without fear or favor. So that is a broader issue that probably needs to be addressed. In time to come, maybe setting benchmarks of performance using external fund managers for managing parts of the fund with the necessary safeguards in place may be worth considering, but much work will need to be done to convince stakeholders before embarking on such an exercise, because there have been some attempts made in the past, I think not necessarily in the EPF, in some of the other government funds, which have not really been had great results.